Here let's look at the valuation aspect of the equity. When I say valuation, my intention is to find out at what price this particular security can be bought or sold. Any valuation for that matter. So if a buyer looks at it, potential buyer looks at it, he will look at it as what is the price, what is the maximum price I should pay to purchase this. When I look at it from a seller side, he will look at it as what is the maximum price I should pay to sell it, or maximum price at which I should sell it. So for this, most of the time there are 2 3 methods people follow. One, they look at the future benefit, and based on the future benefit, they try to find out how much needs to be spent today. That's one of the typical valuation mechanisms. Two, they try to compare it with others, right? Even if I have to say what is the price I should pay to purchase this TV. One is I look at the parts and the components, electronics, everything. I may be knowing, I may not be knowing. If I know it, probably based on that, I'll say, oh, this is not worth more than this. On the other side, I'll try to compare. Okay, if X brand is charging this much, this guy is charging much more than that, so let me not buy it. So these are all the different ways in which we decide how much, what is the value of that particular product according to us. Value is always analyst specific, individual specific. It is not the price which the company has set. The price is a uniformity, but the value is more and more specific to the analyst or the purchaser or the seller. Now, from that perspective, there are a couple of tools which we are going to look at. But of course, L2 is completely on this aspect itself. More than 50%. I think in L2 there are close to 15 chapters in equity. Right, and almost 8 chapters of equity are very heavy on these valuation calculations itself. Different types of valuation mechanisms. So equity is very heavy. Even the weightage wise, I think close to 20 to 25% also will come from equity itself there. So that's the kind of depth that it carries. But here it's only one chapter that is dedicated for that purpose, just introducing you to the basic concepts of valuation. So in this context, there is a definition between overvalued versus undervalued. So market price is always fixed, whereas the price which we think is worth buying or selling is what we call as the intrinsic value. So look at from the concept, from the perspective of a buyer. The maximum price I am willing to pay to buy that security is what I am calling as the valuation according to me. And that particular value we call is as the intrinsic value. The inherent value as per the analyst, as per the evaluation of the features or whatever of that security or the product, what is the inbuilt value of the company. It's not the market price. So if I see that the intrinsic value is less than the market value is the price that is available on the stock market. Now I feel, oh, it is very much higher. The market price is higher than what I am really feeling. So better not to buy it. Or if I already have it, better sell it. The other way is if the intrinsic value is higher. Now I think according to my calculation, it came out that Infosys is worth 2,800. But market it is only 2,500 odd. Then probably I may say, according to me, its worth is 2,800. But it is in the market, it is available only at 2,500. So let me go ahead and buy it. When you are doing, you may say that Infosys is worth only 2,400 because of whatever the assumptions you thought about the future of Infosys. You felt that the number is only 2,400. So that makes you, it's not worth buying it now. If at all I have it, let me sell it off. So that is where we use the words of overvalue versus undervalue. If the market price is greater than the intrinsic value, we call it as overvalued, and the other side we call it as undervalued. And so wherever there is a difference between our intrinsic value and the market value, there is a scope for buying and selling. That is what we typically call as mispricing. According to us, it is mispriced. So there is a scope for us to typically either buy or sell that particular security. So that's where the valuation. So what process I use to arrive at that value are the different methods of valuation available. Now, there could be again on a major basis, if I have to look at, one set of valuation models are called as DCF models, discounted cash flow models, which are very commonly used kind of models. All we look at is what all cash flows can come. If I am investing in this particular share today, what all cash flows can come to me in future? Dividends, and whenever I sell it out, probably that capital appreciation, right? Capital gain. So these are the two things only I can get when I am buying an equity share. If I don't sell it, if I have no intention to sell it, like the promoters, they have no intention to sell it. So forever the only thing they are getting is equity, dividend. Whenever I want to sell it, it's a capital gain. But if I am not selling it, it's only dividend that I am going to get from the company. So how much dividend I can get in future, I have to forecast that. And based on how much dividend I am expecting in future, I'll try to discount all the future cash flows to the present value and say this is the today's value of all the future benefits. So at the max, I am willing to spend nothing more than that. So the maximum price I am willing to spend is equal to the present value of all the future benefits. That is how people use the DCF models. So the cash flows typically are the dividends, right? But as an alternative to dividend, there are a couple of other things also people have come out with. So that's how the different models have come out. But as such, when we are talking of discounted cash flows, I have to identify what are the cash flows that are going to come to me in future because of investing in this particular security, discount them to the present value, and say that this is the maximum amount I am willing to pay to purchase that particular share. Then the other kind of models are multiplier based models, which are more like relative valuation. Compare one ratio of this company with a ratio of some other company or industry average. If this company's number is more than the industry average, I may say take a sell decision. If it is less than the industry average, I may take off a buy decision. So the buying and selling or the valuation or the number which I am willing to give to that particular company could be based on comparison with its competitors and the industry average also. So such kind of, without looking at how much it will give in future, nothing. Just looking at the comparison between the competitors and all, I'll decide this is the worth of it. This much can be paid to purchase this share. That is what is a multiplier based approach, which is also called as a relative valuation kind of an approach. Then there are a couple of more multipliers like enterprise values. We'll look at a couple of those terms. But the third category of valuation is an asset based model. You totally value so if I, especially for a company like me, not traded, nothing. If someone has to buy this particular company, the only thing they will look at is, okay, they'll look at all the assets. So this is the worth of all these assets. Minus, okay, what liabilities? Does he have some loans or something? What liabilities are still pending from him? Whatever is the net that is still there, I'll call that as the worth of this company. That is the maximum amount that can be paid to purchase that company. Especially when a company is not that heavily listed, right? You don't you don't have a big data that is available about that company and all. People can even resort to this asset based valuation model because no dividend is paid, nothing is available about that particular company, or no comparison. There is not even a competitor or something, or I cannot even forecast what the future of this kind of business is going to be. Then the better thing is just value the assets of that company and say this is the total worth of the company. So that's where we'll start off with the discounted cash flow model, where we are looking at what are the cash flows that are coming to me in future. So in normal case, the only cash flows in case of equity investment are either dividend or capital gains. The moment I purchase a share of the company, after that, there are only two things I get from that purchase. On a regular basis, I may get some dividend. Whenever I am going to sell it, I will get a capital gain. Now, all that needs to be done as a part of this process is identify when you are getting how much. Right? These people here, they talk about 100 different models, 1 stage, 2 stage, 10 stage, whatever it is. It hardly matters. Just from a calculation standpoint, identify when you are getting how much. When you are getting the dividends, when you are getting the capital gain. Discount all of them to the present value using your NPV kind of formula, or each one with a PV kind of a formula, whatever it is, you discount them to the present value. Using what interest rate you have to use? You use the required rate of return or the cost of equity of this particular company, which would be given to you in some form or the other. The cost of equity or required rate of return, something of that sort will be given to you as a part of this question. So you need to know all the dividends, all the capital gain that you can get out of this investment, discount all of them to the present value, and say that this is the worth of this company. Well, as simple as that. Right? Now, if there is a company which is not giving dividends, there could be some companies which may not pay any dividend, but which means they are retaining 100% of their profits. Then you cannot say because dividends are zero, the present value of all of them is going to be zero. You cannot say that this company is worth zero, right? Because they are growing. So the point is, even if they are not giving dividend, so if they are not giving dividend, using dividend as a mechanism and discounting those cash flows is going to be slightly not appropriate. So that's where another model in DCF has come out. Apart from dividend, people have come out with another model in DCF, which is called as a free cash flow to the equity. The way this free cash flow to the equity is looked at is, what is the cash that is really available with the company? Whether it pays it or does not pay it, whether it pays it or retains it, but what is the cash that is available with the company to pay to all its investors, to pay to its equity investors? How much of cash is really available with the company this year? Whether it pays in the form of dividend or it retains it, it's a separate issue. So the way they have come out with computing the free cash flow to the equity is simply you look at the cash flow from operations. So from your cash flow from operations, you remove your capital expenditure. Capital expenditure is what you have spent on the fixed assets this period. And any kind of net borrowings or payments which you have done. If you have done a principal repayment, the cash is down. You cannot pay to your equity investor. If you have taken a new loan, cash is available. You can pay to the equity investor. So that is what we take as a net borrowing. So what people say is, if the company's dividend pattern is not that appropriate, is not having some kind of pattern or something which you can really forecast, the other way is, instead of looking at dividend, which is the reality, look at the potential to pay dividend. How much can it pay? Rather than looking at how much is it paying, look at how much can it pay. Right? You look at how much can it pay by going with this kind of. So what is the cash that is really available with the company? It's not the total cash flow, because we are talking about the cash that is available to pay to its equity investors only, the last year's investors, not the new investors who are coming in, right? So I will look at only this aspect, cash flow from operations. Out of that, I'll remove what all I have invested to buy the plants, machineries and all, which is the capital expenditure. And I will add any new borrowings or any repayments. I'll subtract any repayment, principal repayment I have done in this period. That is what will give me the free cash flow to equity. And people will project what would be the free cash flow to the equity in the future. Again, discount, instead of discounting the dividends to the present value, we are discounting the free cash flow to the equity to the present values. So that's where we are saying free cash flow to the equity reflects the firm's capacity for dividend. How much can it really pay as a dividend? Rather than looking at how much is it paying a dividend. Whether, so here what happens, see, dividend is as per the dividend policy of the company. If the management thinks let's pay a dividend, they'll pay. If they think that let's not pay a dividend this year, they will not pay. So it is more, it's more of a decision which the management is taking. It may not reflect the potential of the company to the fullest. If they find good opportunities next year, even though they have performed well this year, they may not give any dividend. They may want to retain everything. But if the opportunities are not there next year, even if they did not do well this year, that amount they would like to give as a dividend itself. So may or may not be a good reflection. Dividend may or may not be a good reflection about the performance. So that's where what this free cash flow is trying to address is whether the company pays a dividend or not pays a dividend. We are looking at the potential of that company to pay a dividend. And based on that, trying to, instead of dividend, we take the potential of dividend and try to do the same thing which we are doing with the dividend itself. Then, yeah, just look at a couple of numericals to do a valuation. Calculate the value of a stock that paid a dividend of 1 last year. Next year's dividend will be 5% higher. Stock will sell for 13.45 at the year end. The required return is 13.2. Required return is nothing but your cost of equity, which you will use it for the discounting purpose. Now, what are all the cash flows that I am going to get? There is one dividend which I am going to get, which is all the future only, not historical. It paid 1 last year. But so I am going to get next year dividend is 5% higher. So I will get 1.05 next year. Right? So this I will get after 1 year. What is the present value of this? This is the present value, 1 plus R. Right? This is the present value.